with all decision making, what you have to ask yourself as you go into the decision is, what's worse?
What's the biggest error or the bigger error?
Right.
Yeah.
Is the bigger error a false positive, or is the bigger error a false negative? Because that's going to tell you where you're supposed to set your threshold for good enough.
Hello, fellow data nerds. My guest today is Annie Duke. Annie is a former professional poker player. She's won over $4 million in tournament earnings during her career and holds a World Series of Poker gold bracelet from 2004. Annie's also the author of a number of best-selling books, including Thinking in Bets, which is one of my favorite books, and Quit, The Power of Knowing When to Walk Away. Annie, welcome to World of DAS.
Thank you for having me.
Very excited. Now,
I'm very excited.
When you look at like how venture capitalists evaluate deals, what are like the big cognitive traps that you see in their decision process?
Right. So I would say, okay, I'm going to try to bucket these. The first one is that I think that there's, in general, in venture, a lot of sort of mystique around gut decision making, right? I mean, that's a little bit like what the Midas list is about. It's this idea of like there's a magical investor who just has a really good eye for talent. And there's just a lot of reliance on that almost as your decision making process, right? That this person who has such a good, sort of eye for talent or nose for value should really be driving the train on a decision about whether to invest. So like we can go into that. That's like the first big bucket that I think is a really big trap. The second has to do with just like a lot of cross influence, and then this really big problem of, I think, pretty bad record keeping, like accumulation of data around the decision point itself.
So like, because when you go back to your winners, you remember these people as being super charismatic. And when you go back to your losers, you remember them as like, stumbling and you just invested anyway. You're not sure why type of thing.
Or I think there's also the problem of when you're operating a world that's governed by power law, right? It's very easy to just say, well, that was just one of the losers in my portfolio, right? Like, because you're expecting, maybe you're hoping for maybe 3 fund returners in a fund, right? Out of, 25 to 40 investments. So I think that, in a world where there's so much luck, it's really easy just to say like, well, I lost that. That doesn't have anything to do with my decision process. Like, that's just the way it is. And that one that I won, I totally saw it. Right. And so I think that's a big bucket as well. And there's no way, if you're not really keeping a really good record, like creating a really good artifact of your decision at the time that you invest, I don't think there's a really good way to resolve that, right? To really look back and say, was that a good decision or not? And I think that's really hard. So that would be kind of like bucket number 2.
And also, I mean, is part of the problem just these decisions are very long range. Like you might not know for 10 years or so.
In bucket number 3 is pretending like things are long cycle when they're not. So that's a great one. I wasn't even going to bucket that one, but I'll just put that in one big bucket, right? Like just sort of like waving your hands and saying it's very long cycle, but it's actually not. I think number 3 would be that I think there's not enough attention paid to follow-on decisions. In a variety of ways, and we can talk about that. And then number 4 is that I think that there's just a lot of misuse of data. Like, I think there's a lot of data mining happening. I think there's a lot of survivorship bias that's really driving some of the data work. And I think that there's this is this topic of when you're looking at data that is true, right? Because it's like data about your own fund or your own sales process or your own whatever it is. So it's going to survive a fact check, right? So, I mean, those are like, I think those are sort of the big ideas.
Let's talk about the follow-on decisions a bit. Like where do you see, is it just like they always do follow-ons, or they don't do super pro rata enough, or they're not as discerning, or they don't think it through? Like, where do you think their decisions could be better?
Well, okay, so I think that there's a few problems. Look, there people very often follow on at the next round, not necessarily as a value bet, but because they're trying to support their investors. And so I'm not talking about that, right? I'm not talking about a different bucket of following on, where you're following on for reasons that don't have to do with really trying to discern what which companies in your portfolio are going to have the highest return or not, but you're doing it because you're being supportive of your founders. And so that's a wholly different bucket, which I have no critique of.
Yep.
But there are lots of follow-on decisions that are made that are not for that reason, that are actually value decisions, right? Like where you're actually trying to identify the companies that you have put in your portfolio that you believe are going to have the highest return. And so therefore you would like to put more money in them because you think the probability that they're going to be a fund returner is very high. And what I think that I found when I talk to venture firms that aren't my clients, is that there's just a lot of sort of, if point partner is pounding the table, then we're going to do it.
Mm-hmm.
And I think that people need to be more aware of some of the cognitive biases that can really get in the way of good decision making around these types of decisions. Number one is that everybody should familiarize themselves with endowment bias. So the endowment effect is that you like things that you own more than identical things that you don't own. That includes ideas. So I think we've all heard where like you'll give some idea in a meeting, and then somebody else who sort of poo-pooed your idea will like say the same idea and they'll think it's great, and you're like, wait a minute, what happened there? So it's true for ideas as well. So we just like things that we own much more than identical things that we don't own. So a simple example of that would be like, I'm sure everybody at some point in their life has sold a car. And when you look at the Kelley Blue Book, sort of what you're supposed to be getting for the car, you're like, well, obviously I should get top end for this car. Like, this is a great car. But if you were buying the identical car, you would be arguing for the bottom of Kelley Blue Book. I mean, there's no question that that's true. And the science on this is very strong. It's well replicated that people just like stuff they own better than stuff they don't.
But on the VC perspective, it seems like a lot of VCs, when, let's say they're evaluating, like doing more money in the Series D and they were in the Series A, and it's already up 50 plus X, and it's already maybe potentially a fund returner for them. I think sometimes I see the bias going the other way, where they're like, this is already a fund returner. I shouldn't put more eggs necessarily in this basket. Maybe even I should take some off the table here. So I feel like much more likely they're going the other way at that point.
Yeah. So it depends on where you're following on, right? So endowment is a problem, right? Which is this idea of point partner pounding the table. One of the concerns that I always have is that point partner is probably the most endowed.
Yep.
Right. As we think about that, I mean, obviously the whole partnership has that company in their portfolio, but point partner is going to be the most endowed, which I think is just like an interesting problem. The problem that you just talked about, and then there's a third problem that I'll get to, is so this is research that the first finding in this category is from Kahneman, Tversky in 1979. So Daniel Kahneman actually ended up eventually winning the Nobel laureate for something called prospect theory. And this finding from 1979 was really a key point of prospect theory. And it has to do with like sure loss aversion, sure loss aversion, and then this idea of how we deal with gains. So it kind of, this is kind of the thought experiment. So let me kind of maybe you can play along a little bit. All right. So you owe me $100, and so you owe me $100, right? So you're going to have to give me $100, or I offer you a coin flip, and we can flip a coin, double or nothing. So would you like, does your gut sort of tell you like, yeah, I'll gamble there?
No,
Or
if my gut says I give you because the two does the zero. I don't know. The zero loss doesn't seem like that great. I'll just I'd rather just give you $100 than have the $200 loss.
okay, so the majority of people in that situation will actually go for the gamble.
They would.
Hmm.
Really? So
So, and the
they would
expected
take the
value,
50% chance of paying more?
well, the expected value is actually identical.
No, of course, but
Yeah.
the
So,
downside is a lot more. The downside side is a lot higher.
yeah, but you have a chance to get even, which is why people will take that bet.
Oh, interesting.
So,
Okay,
um,
I'm surprised. I would have thought most people
well, yeah, you know,
would be risk averse like me.
so we've got Kahneman, Tversky, 1979. They offer two propositions to participants in the study.
If you're enjoying this podcast, please sign up for our newsletter. Go to worldofdas.com. The link is in the description below. Now back to the video.
Okay, so the first one is I can give you $100, or we can flip double or nothing, and you can win $200, you can win zero. And the question is, are people willing to take that bet? Obviously, the expected value is the same. It's $100 either way.
Yeah.
But will people take that bet? And the answer is no, they will not. But when you say you owe me $100, or we can flip double or nothing, do you want to take that bet? Then the majority of people will take that bet. So notice that in both cases, the expected value is the same. The only thing that's different is whether you're in the gains, right? So I
Yep.
can give you money, or you're in the losses, so you can give me money, right? So
Question
that's
for
what's
you on
different.
the first one, which I think is a simpler one for people to understand. What are the odds that people are willing to switch? Because 50-50, I'm taking $100 for sure. But at 60-40, I'm probably willing to roll the dice.
Well, so that's an interesting thing. So that everybody has a different indifference point. But basically, the finding is like, if I say I can give you $100, so tell me what I mean. You're obviously you understand expected value, but like, what is your instinct about what most people would say? If I say you've got $100 in your hand, like I'm going to hand it to you, or we can flip double or nothing. You'll win 220 or lose zero or win zero.
Yeah, my expectation is they take the 100 on the 220. Yeah,
Right. So they
it would
just
have to
take the 100
be
there.
Probably
Pretty
over
big.
300 for the average
Exactly.
person to be able to. Now, $100
Totally.
maybe not. Now, if you're talking $10,000, like we're really like at that, maybe at $100, like sure, I'll take the 220 because like maybe neither of them moves the needle
But
for
they
them.
don't take the 220.
Okay,
Not even
interesting.
then.
Yeah, I mean, but these are always with poor college students. But let's say with like
Sure, but
the
if you made
average
it
American, where like
10,000 and we can
$10,000
flip,
like
right,
really changes the game for them, they'll probably take the 10,000 rather than roll the dice for
for 11,000.
22,000 or something.
22,000 rather, yeah. So, I mean, of course, in the 100 versus 220, they're costing themselves $10 in that spot.
Yep.
In order to not take the gamble. So basically, they're paying to take the variance to zero, right? So
Yep.
what they're trying to do is take the sure gain. So the pain of like having been up 100 and going to zero would be too great. All right. So now we can take the other side and say, what if somebody like you're going to have to give me $100, or we can flip zero or 220? People take that bet. So notice that's $10 worse for them. So now they're paying $10 to keep the gamble on.
That just seems crazy to me. Assuming they could afford the $100. Now, if someone can't afford it, I could see how they would take the bet. Because they're going bankrupt anyway, so they might as well take the gamble. But so if you're like, oh, it's $1 million loss and they can't afford the $1 million, and the gamble makes a lot more sense to me than, well, 2.2 million, who cares? I'm already so much in debt, like it doesn't matter. But $100 doesn't make that sense to me on that side.
Yeah. So what's interesting there is that's why that paper was so groundbreaking, because prior to that, economists who could calculate the expected value were like, well, if you offer those two things, people won't behave differently.
Mm-hmm.
So let's go back to the original one, right? So what an economist would have said is that you have some sort of risk appetite, right? And so if you're willing to take the gamble when you're in the gains, you would also be willing to take the gamble when you're in the losses, because those are symmetrical problems. Right. So if I owe you $100 and you want to take the gamble, an economist at that time would have predicted that you would also take the gamble
It's not exactly true because, like, if you add $1 million to your net worth, let's say your net worth is $10 million and you add $1 million to your net worth, your net worth only goes up by 9%. But if you take $1 million out of your net worth, your net worth goes down by 11%. So you are actually way worse off you're kind of to lose that $1 million than
we
to.
can control for that, right?
Yep.
So we can control for that. So let's assume, so what economists would have said at that point is, prior to this, is people have risk appetites and people are either risky or not. And if they're willing to take the risk and flip the coin in the gain situation, they will also do that in the loss situation and vice versa. But it turns out that people are very different when it comes to the two propositions. They will not take that bet when they are winning, but they will take the bet when they're losing, which actually, interestingly enough, is the opposite of what you just said, right?
Yeah.
Even if we take into account the
totally
10 versus 11% or whatever, right? So you would predict the opposite.
Yeah,
but this is the problem. Like, when we're actually calculating, so what would a rational actor do? This is not what they actually end up doing. So they take the gamble when they're in the losses, and they take the gains when they're in the they take the gain when they're the money when they're in the gain. So they refuse the gamble. Okay, so what's happening there is that we are very averse to taking losses on paper and turning them into realized losses, and we seek to take gains on paper and turn them on to realized gains, even when it is irrational for us to do so.
Yep.
Right. So
no, but just to jump in, like, the venture capitalist is very weird because in taking so there's a scenario where let's say you're going to write down a company to zero, or today. Or there's 100% probability you're going to write down that same company in 5 years to zero. You would think you'd want to do it as soon as possible from your kind of IRR perspective or something. Or let's say even simpler. Let's say the company can give you back all their money today that you put in. So it's a 1x today. You put $1 million into the company, it'll give you back 1x today. Or the company will give you back 1x five years from now, right? You would think every venture capitalist would rather have the 1x today, but almost every venture capitalist would rather have the 1x 5 years from now because they're fundraising, there's stories on it, there's other types of things that they would prefer.
It's not just that, though. It's this. So if I write a company down today, right, I am taking the loss. As long as that company exists on paper,
there's a chance.
I have not lost yet.
Yep.
Right? So this is the exact same problem. It's the reason why people will flip the coin even though they could lose 220, right? It's the exact same thing. Why are you keeping the risk on, right? Because if I write it down today, I'm just taking the risk. I'm like, I'm done, right?
Yep.
So why are you keeping the risk on? Because as long as you do that, you haven't actually realized the loss. That's the way that it feels to us, right? In venture capital, if you take a 1x return, that's a loss.
Correct.
Right. So you're just not going to do that because the frame in venture is, 10x or better. Right.
Yep.
Like, so that's kind of the frame. And so, anything that's kind of less than that, you're sort of considering a loss. So if we go to, like, why are people taking money off the table at Series D with an amazing company that's already returned 50x? Well, because they're already in the gains.
Yep.
And we know that there's some probability that even if a company is marked at 50x, it can go to zero.
We've seen it all. We've seen it happen many times.
Exactly. Yeah. So if you don't continue to bet on that, and in fact, if you trade on the secondary, you're realizing that gain. You're taking all the risk out of it. And we like to do that, when we're in the gains, right? So this became like the cornerstone. This research became the cornerstone of prospect theory, which ended up winning Daniel Kahneman the Nobel laureate in economics. But this is very basic human behavior. And what you're pointing out about these scenarios that you've offered up in venture is just a real life instantiation of prospect theory, of what you see. And if people are interested, there's very interesting work by Richard Thaler, who's also a Nobel laureate in economics on mental accounting. And what I think is important to note is this. So one of the things that people will say to me is, but why would you behave that way toward one company? Isn't that the whole point of having a portfolio, right? I mean, that's the base of portfolio theory, right? And what Richard Thaler's work shows is that you don't think about it as a portfolio, though, when you're approaching a decision about a single company. So whenever if we put a company in our portfolio, we've now opened an account up, a mental account for that company. And we're tracking that company. We're not actually thinking across the portfolio, because obviously if we're thinking across the portfolio, you might not make the types of trades that you're talking about, right? You might be willing to take 1x today. You might be willing to write a company to zero today. You might be willing to do what you're sort of rationally supposed to do at Series D, but you don't. If you're actually thinking about it in the context of the portfolio, but that's not the way we think about it. We think about it, we open an account for that thing. So like a classic example, and I think this is a pretty easy thought experiment for people to kind of wrap their heads around, is you buy a stock at 50 and it's trading at 40. If you were approaching the stock fresh today, you would not buy it. Do you sell it? And the answer is no, because you want to get your money back.
Yep.
Well, that's silly, because it's like across all stocks and there's opportunity costs associated with that. You could put that money, that $40 into another stock that has a higher expected value, right? But we won't do it. Now, how do we know that this isn't like a kind of a ledger problem, but it's actually a cognitive problem, mental accounting problem? Well, because of this scenario. You buy its stock at 50, it goes up to 75 and it's trading at 75 for a while. And now it goes down to 60. Do you sell? Notice that on your physical ledger here, you're $10 in the gains.
Yeah.
But on your cognitive ledger, you're $15 in the losses, because you were at 75. And people won't trade under those circumstances either. And so what's interesting is, like, once you can clear the account, we'll tend to approach risk more rationally, but we have to clear the account in order to do it. In other words, like if I do actually get forced to sell that stock, or somehow I end up selling it, the next decision that I make about a new stock is going to be more rational than the decision I would make about that stock. And there's some really fun research which shows that using casino players' tracking cards, that when people are playing slots and they get into a loss situation, that they'll really play a very long time, right? So they'll continue to go.
Yep.
But once they leave for the day, right? So that they'll not only continue to
like
go,
once they go to sleep and come back, then they're more rational again.
Right, because it's a new account. So what's happening is that as they get in the losses, and you sort of track them at sort of at the end of a session where they're in the losses, their bets get bigger, they play faster, they're really just taking on more risk, right? But then when they leave, the next time they come back, they start at their baseline again, because they've closed that mental account.
And that is because of that mental account, not just because they're more wasted or something. Or
No. And this is like, you can see this across, like this is a very large scale study. Yeah.
Question for if you think of a private equity person, their main job is just never to lose money. Like that's the worst thing that they could do. And there are some private equity firms that have never lost money on a deal. If you think of a venture capitalist, which is different, their biggest mistake they can make is not investing in that 50 bagger that comes across their desk, because that 50 bagger may only come across their desk every few years. And they have to make sure that they invest in that particular thing. And if they don't do it, it's just a huge monumental mistake that they make. How do you square those when you're kind of talking to people?
So this is true of all decision making, is you need to figure out what type of error is worse. So what you're describing is a type 1 or type 2 error.
Yep.
And you've also heard it talked about as specificity versus sensitivity. That was something that got sort of
kind of a false
around.
Positive versus false negative or something like that.
Right, exactly. So So basically, so let's think about it as sensitivity versus specificity to start. Um, so let's imagine that we're testing people for COVID. Okay, so we're way back when, we're back in
Yep.
2020 in the pandemic, and we test people for COVID. A sensitive test is always going to capture people who have COVID. What that means is that you're going to have a lot of false negatives,
Mm-hmm.
right? Because it's going to be flashing a lot, right? It's going to be like COVID, COVID, COVID
Yep.
all the time. Now, you're never going to miss somebody who has COVID in that scenario, but you're going to capture a lot of
You'll have
people.
false positives. You mean you'll have tons of false
False
positives,
positives, I
but you
meant,
won't
right?
have
Did I
false
say false
negatives.
negatives?
Yep.
Sorry. So I meant false positives. So you'll have lots and lots of false positives. You're going to capture a lot of people who don't have COVID
Yep.
in that set. Okay. Specificity would be that you're really trying to only catch the people who have COVID. Okay. So in that particular case, um, we're going to miss a lot of people who have COVID.
Yep.
Right. So there's always a tension between the two. And it depends on a variety of factors, whether you're going to lean towards sensitivity or specificity.
So just to kind of like walk with your example, if we're going to test everyone in the country and only 1% of people have COVID, we wouldn't want to test with even a 1% false positive rate, because then we like literally 50% of the people who take the test would say they're positive when they're not.
So that would depend on how dangerous the disease was.
Correct. Okay. Good
So
point.
in a case
Yep.
where you were 100% to die, if you had it, you would be very tolerant of false positives.
Yep. Okay.
So that's
Good
actually
point.
kind of, this is where it gets really interesting, right? It's not that you would never
But
want.
you could, in that case, you could freak the other 50% out or
That is
something,
true,
and
but
they might
assuming
do
there was
something
other
crazy. Yeah.
given that it's highly, like, let's imagine something that's highly contagious and kills everybody who gets it. It's totally fine if you have a test that's really high on sensitivity
Yep.
and low on specificity, right? But we don't want that for something that is is lower down on the danger rate. So, like, one of the ways that I like to think about it is it's really good for mice out in the wild to index on sensitivity as opposed to specificity, right? Because if they don't run away when a predator is coming,
Yeah.
they're little tiny mice. They're gonna be dead.
Yep.
So it's better for them to just run away way
Just
too often.
assume the danger.
Assume the
I'll do that
danger,
too. Like
run
if I think
away.
there's a lion, I'm not going through that brush
Right,
if I think there's a
exactly.
lion there.
So
Yeah.
fine, right? Okay. So that's totally fine. Um, so but if you're like an elephant, right? So now maybe you're not just running away because, like, you can fend off a lot of predators, and it's a whole bunch of energy. There's a big energy cost to you to actually run away like
Yep. Okay. I like that.
Right.
That's a good analogy.
Yeah, I mean, I think that's something that actually is kind of stuck in my brain. So mice. So let's bring it to like type 1 versus type 2 error. Mice are making a lot of type 1 errors, lots of false positives. They're like bling, 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 predator, predator, predator all the time, and they're running away a lot when they probably don't need to. But that is better for them because they're little tiny mice. But elephants are going to make more type 2 errors, which is false negatives. But then again, they're very big, and there's a big energy cost to running away and that kind of thing. So elephants and mice should actually be different in that way. Okay, so let's bring this back now to all decision making. With all decision making, what you have to ask yourself as you go into the decision is, what's worse?
What's the biggest error or the bigger error?
Right.
Yeah.
Is the bigger error a false positive, or is the bigger error a false negative? Because that's going to tell you where you're supposed to set your threshold for good enough, right?
Yeah.
So what's the point at which I've built enough conviction in order to be willing to invest in this, right? So if we take a long short fund, for example, they're going to not want to have a lot of false positives. right? They've got a very
Yep.
small portfolio. They tend to hold a very small number of positions for a very long time.
And they can be choosy, so
They can be
they can
very
pass on
choosy.
tons of deals if it
Right.
works out, it works out. But
Yeah, if they
and they can
miss
learn from
something that
it.
makes a lot of money, it's fine because they can probably get something else that makes a lot of money. Like it's not
Yep.
really a big deal, and so you're not really too worried about false negatives in that world, right? But in venture, you're very worried about false negatives because there's a huge penalty because of power law.
Yeah.
There's a huge penalty to missing a winner. That's a ginormous penalty. So generally, what we can sort of think about there is that um, if really worried about false negatives, what that means is that we're going into it understanding that we're going to kind of purposely, right, end up with duds in our portfolio.
Mhm.
We don't know which they're going to be because there's
You're willing
uncertainty.
to have a higher loss ratio, essentially, then
We're
too,
going to have
right?
a much higher loss
Yeah.
ratio, but we're tolerating that and we're going to construct our portfolio to withstand that.
Yeah.
So, if you look at some long short funds, or Berkshire Hathaway or whatever, it's like they have a very small number of positions. Um, whereas venture firms have a very large number of
So
positions
even
and you
most
have to
venture
withstand
firms,
that.
like they have, in a given fund, they may only have like 20 positions or something like that. Like, do you think they should have 50 to 100 positions or more in those funds or something to deal with
Well,
that?
so there's a trade-off, right? Which is, look, let's take it to the extreme. If I invest in everything,
Yep.
I will
Yep.
never miss anything.
Right.
So remember, just because we're saying we're not really tolerant about false negatives, it doesn't mean that there aren't going to be false negatives,
Yeah, of course.
right? So one of the things that I say is that if you're investing well, two things are always going to be true. You're going to pass on something that wins, and you're going to invest in something that loses.
Yeah,
And
100%.
I can always guarantee that.
Yep.
I can always guarantee that. And the worst mistakes that you can make, I think, as an investor, there's two of them. One is looking at the bottom performers of your portfolio, drawing conclusions that are way too big given the amount of luck, and starting to change your investment process to try to prune the bottom range of your somehow looking forward,
Yep.
right? To prune the bottom range of your portfolio. I just think that's a huge error, right? Not that you can't learn something
Yeah.
from your
Yeah.
losers, but it's probably a relatively small sample size and there's a lot of luck. And if you reran it 100 times, those might be the top of your portfolio. Like there's a
Yep.
whole, right. There's a bunch of stuff that can happen there. Right. So that's one big mistake. And then the other big mistake you can make is trying to make it so you literally never have a false negative.
Yeah.
Right. Because then you're just not going to be choosy at all. And what's your point on earth? Right.
Yep.
Like,
Yep.
why are you a
Exactly.
steward of
And
somebody
also,
else's
like, it'd be
capital?
impossible to invest in anything anyway, because, like, of any meaningful amount, no one has
Right.
like $1 trillion.
Exactly.
So,
Yeah, but also like the whole point, the whole reason that
right.
LPs are investing in you is because they feel like you have good taste.
Yeah. 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 Yeah.
So
One of my things I struggle with is just bet sizing. And because you could just say a scenario where, like, imagine that same seed fund, they just put $1 million in everything and it's just simple, or they own like, 5% of everything, whatever they decide that, and that's kind of how they bet size. Or there's something where you're being a little bit more discerning. You're okay. I'm putting more risk in this. I'm having my normal allocation this other thing. Like, how should funds think about that?
so I a little bit like look, your mileage may vary. I don't want people to take this as like
Yeah.
investment advice from me. I just want people to kind of take this as just sort of like where, because of my training in cognitive science, my head goes with that. Um, in early stage venture, you're making decisions under extreme uncertainty. That
Extreme.
uncertainty comes
Yeah.
from two places. One is you know very little. I mean, if you think about an angel investor, it's like, hey, I have a pack of gum and idea,
Yeah.
right?
Totally.
Like there is no product market fit.
Yeah,
There's
you
no,
may know something about the founders.
but that's it. Like you
Yeah,
really don't know
you've worked with
anything.
them before. You
Yeah.
have some sort of sense that they're quality people or something.
Exactly. So like you really don't know anything and there's just a whole lot of luck. As I say, like if you reran Uber 100 times, I don't know how many times it ends up being Uber,
Yeah.
but it's probably low. just because,
Yep.
right?
Yeah.
Like
Well, that's
it's
probably for every company. It's probably
for
like
every
that.
single
Yeah. Yeah.
company, right? Like that's just it. You're not going to do it 100 times out of 100. As much as the
Yep.
people who founded Uber would like to think that they would win 100 times out of 100, I would certainly short that position. So,
Yeah. Though I would say if you actually look at it at a founder level, and let's say that founder has the ability to found many companies over time, I think that there's a much higher correlation with success. So my guess is like Travis Kalanick would maybe not be at the same wealthy as if you ran the simulation a million times or something, but he probably would be pretty successful in most scenarios. And he would, if Uber didn't work, he'd do something else or something. Where like he's
yeah,
just that
although
type of guy
there's
who
a
would be
lot of
pretty
yeah, that's
successful.
true. Although there's a lot of path dependence there, right? So if you do well in one company, you're more likely to have opportunities in another
Of
company. But
course, yeah,
regardless, and then so we've got hidden information and luck, right? So um, so those are two. And by the way, here's the thing: if he doesn't do well in Uber, you don't know. He may choose something less risky,
that's true.
right? So we don't
Yeah,
know, right? Because
yeah,
it's
that's right.
right.
Yeah,
It's path
he might
dependent.
become a product manager at
Exactly.
Facebook or something.
Right. We
Yeah,
don't know what's
yeah,
going to happen. So, but okay. So this is so where I kind of think about like really what is our acuity, right? What is our cognitive acuity to be able to distinguish one thing from another, to be able to distinguish one thing from another. Um, and I actually like to analogize it to choosing something off a menu. So you'll see people all the time who are looking at a menu and they're like, I can't decide, right? Do I want the chicken or the
yeah,
fish?
yeah.
And it's
Right.
like, and it's like they're quizzing everybody at the table and they're asking the wait staff and maybe they're looking up Yelp reviews. I don't know. But they're having a really hard
Yeah, or
time.
even like what movie to watch tonight or something.
Yeah, exactly. Like what should I wear? What should I
Yeah,
eat? What vacation
it's
should I
like
go
the
on?
optimizer personality.
They're trying to optimize exactly. And and then they finally somehow decide on something, like they order the chicken and then it comes back dry and they immediately think they made a mistake.
Mm-hmm.
But like the last time I checked, when they were trying to order off the menu, they hadn't eaten those dishes before. I'm assuming it's a new restaurant.
Yep.
And they don't really know anything. So they're not omniscient and they don't have a time machine. So like, is that really a mistake? Like they narrowed it down to two things they really like.
Yeah.
And then they made a choice. So one of the things I like to point out to people is like, it's not like you're having trouble choosing between what's a dish that like, what's a food that you hate?
I don't like olives.
Great. So it's not like you're having trouble choosing between the chicken pasta and the puttanesca. That is not a problem for you.
Right.
Now, the reason why that's not a problem for you is because they're so far apart that one of them does not meet your threshold for good enough. All right, so we can think about this threshold for good enough and what does that threshold look like? How do we figure out when two options are good enough? When we say to ourselves, if this were the only thing that I could order, would I be fine ordering it?
Yeah. Yep.
And if the answer is yes for the chicken and yes for the fish, you're kind of done with the process at that point. It's like, okay, they're both good enough. I can really flip a coin between the two and it doesn't matter. Right? Okay. So that's a talk about ordering in a restaurant. By the way, even if you could tell the difference between the two, what a waste of freaking time, because they're both already good enough, because you're totally fine. You're totally fine ordering either of them off the menu. All right. Now, how do we decide the threshold for good enough? It relates back to that idea of false positives versus false negatives. So the more tolerant we are of false negatives, the lower our threshold for good enough. The less tolerant we are of false negatives, the higher our threshold is for good enough. Okay, so let's just tie that up in a bow. Okay, so how does this relate to like position sizing in really early stage venture? I don't know, you get to something that's good enough.
Yep.
Can you really tell the difference between the two?
Probably not. Yeah.
Yeah.
So maybe I should just do the same thing and everything.
So I think that what ends up happening, I think it's really, my personal feeling is that you have a goal of sort of, and you can decide what the goal is one of two ways. You can decide that you want a certain amount of ownership in a company, or you only want to invest a certain amount in each company, whatever, I don't
Yep.
care. Do you be you, right? But naturally, what's going to happen is that you're going to end up with different size bets regardless, because you can't always get what
You
you
can't always
want,
get your allocation.
right? You
Right.
can't always get
Exactly.
your allocation. And then what you should actually think about is this, right? Like, okay, so I've got my allocation. Now I know more about the company than the market does.
Yeah.
And then you probably can discern later.
Okay. That
Do you
makes
see what I'm
sense.
saying? It's
Yep.
like,
Absolutely.
right. So I just sort of save the whole discernment thing for personally, that's what I would, but that's not what everybody does. And other people do sort of think about big bets, medium sized bets, small size bets. That's fine. I just personally am a little bit skeptical about it. Um, People are welcome to go, sort of look at science on this issue of like, how well can you discern the difference between things that are really similar to each other? And I think it's just really easy for us to tell ourselves stories about that. And I also think it's honestly a little bit of a waste of time. But that, like, again, that's just me. Like, I'm not, no financial advice here. Thank you very much.
What do you, I mean, you mentioned the flipping a coin. What do you think about flipping a coin about a very big decision? Like I have friends and they flip a coin about all the big decisions they make if they're not sure about it. So they even like decided, they even flipped a coin of should they have a fourth kid. So like something like that monumental, they flipped a coin on.
If they feel like it's 50-50,
Yeah, why
absolutely.
not? And just like that's the way to make the decision.
Yeah, it's like, again, like here's a very big decision. Like, I've got a week of vacation time. Should I go to Paris or Rome?
Yep.
Big decision. Last time I checked, nobody has trouble choosing between Paris and
Yeah,
Gary,
they're both
Indiana.
pretty good. Yeah. Yeah.
Right? Like, oh, Paris and Gary, Indiana, I'll just go to Paris.
Yep.
But Paris and Rome, that's actually a really hard decision. And but the thing is that I say hard decision because it feels really hard to people, but it's actually really easy. Right? Like, and this is like, I think it's a big unlock. When
Yep.
a decision is hard, that means it's easy. When it's hard in the sense that, ooh, really can't
They're
decide
both
between these
good.
two
Yeah.
things,
Yeah. Yeah. Yeah.
right? Then just flip a coin.
Or
Like,
two
don't,
job offers that are
right, don't
both
spend
great.
2 months on
You think you'd be good at both.
TripAdvisor.
Yeah. Yeah.
Like, what are you doing? You don't have a time machine. You can't go
Yeah.
and see what it's going to be like when you're there. Like, stop with the 2 months worth of research
But what
on
about the
that.
things like, should I marry this person? Should I have another kid? Like, these things that are maybe more of one-way doors.
Flip a coin.
Okay. All right. I
Look,
love it. Yeah.
again,
Yeah. If
here's
you're
the
not
deal.
sure. Yeah. Obviously, if you have
Right.
data. Yeah.
So, look, if something is really, first of all, a kid is a one-way door. Marriage is not a one-way
Okay.
door.
Cool.
But
Okay. Good point. Yeah.
so one of the things, so I actually don't like the one-way door, two-way door analogy, and I'll tell you why. Having a kid is a one-way door. Death is a one-way door. That's it. Those are the two one-way doors. Everything else is a two-way door, but some of them are more expensive.
Some of them are more expensive to get out of. Yes.
That's right.
Okay. Right. Okay.
So
that's fair.
when we think about how expensive it is,
Yeah, some doors are $1 to get out of, and some doors are
right.
$1 billion to get out.
So what I would love people to do is when it's more expensive to open that door and go back through, when it's more expensive, you should take more time with the decision and you should have a higher threshold for getting to the coin flip.
Yep.
Right. So like, here's kind of how I think about it, right? It's like, there's two ways that we can think about it. One is how expensive is it to reverse, how expensive it is to quit the thing that I'm doing. And the other one is what's the long-term impact if I get a bad outcome? Those are the two things that we want to think about. So let's think about hiring an intern versus hiring a CFO.
Right. Clearly.
If I hire an intern and they don't work out, it probably has no impact on my bottom line in a year. And gosh, it's super easy to reverse at almost no cost to me.
Yeah.
Right. I'm just like, sorry, you didn't work out. Go back to college.
Yeah.
That's it. So my threshold for getting to good enough should be really low in that situation, right? I should have a couple of checklist items that have to do with like, education, recommendations, whatever. I can decide what's on that checklist. And then I should end up with like 20 interns that would be fine.
Yep.
And then I can put their name in a hat and I can pick one and just move on with my life, which is not what people do. They spend weeks trying to sort through the pile of intern resumes, figuring out who to hire. But now let's think about CFO. If I get if I get a bad outcome with the CFO, long term, it's probably going to have an impact on my bottom line. And it's actually quite hard to unwind, right? It's probably pretty expensive. Certainly, severance is a bigger issue. There are big cultural impacts to the organization. I have to go through a big, long search again. That's going to be expensive. Like, there's a whole bunch of stuff that goes on with that. So my threshold for getting good enough with the CFO is going to be higher, which means I have to spend more time on the decision. But in the end, even for one-way door decisions like having a child, if you decide what the threshold is.
Yeah.
Do I need to be leaning 60-40 to do it? Do I need to be 50-50? Right? So you decide whatever that is, and then whatever. If you decide that it's 50-50, maybe you go for it, or maybe you flip a coin. I don't really care.
On the hiring thing, let's say you're hiring for a CFO. The classic thing is like the secretary's problem, where you have n number of people in the pool. You first look at N over E of them, and then you hire the first person after that is better than the first set that's there. Do you subscribe to that, or like you got to look at a few first to know what you want, or how do you think about like in hiring?
So okay, so you're talking about what's the, I don't know what the PC name for that is anymore.
I don't know what it is, but back in the day, in the 60s or when the 70s, they called it the secretary's problem. Yeah.
It used to be called the Sultan's daughter problem.
Oh, the Sultan's daughter. Okay, got it. Okay,
and
so it goes back.
At some point, it was the secretary problem, but I think you're supposed to just call it an apartment hunting problem.
Apartment hunting problem. Okay, sorry, that's the PC way now.
I don't know, whatever. Yeah. Anyway, but I'll give you the original Sultan's daughter problem, because it's important for understanding what the difference is, because there's a difference between the apartment problem and the Sultan's daughter problem that I think is very important to point out. So in the Sultan's daughter problem, it goes like this. So a sultan is going to find a suitor for his daughter, and he selected 100 suitors who are suitable for his daughter. And then
all of them are suitable.
All of them are suitable.
Okay.
Right. All of them, like they're a prince or they're whatever. Right. They like, right. None of them
they're all over a certain
no
bar.
Peasants.
Yeah. Okay.
No peasants.
Yeah.
Okay. So the daughter is going to meet each of them.
Yeah.
And if she rejects one, they're rejected forever.
Yeah.
That's the end of that.
Yep.
And then she's going to have to choose one at some point.
Okay, she's going to meet them consecutively. Yeah.
Okay, so there's some math around this, but it turns out that you should meet 37% of them.
Whereas 100 over E, which would be 37.
Yeah. And then the person who's better than, the ones that you met before, the first person that's kind of like better than the ones you met before, or at least as good as the best person you met before, you should.
I remember doing this in college. Yeah.
Yeah. Okay. So here are the issues that don't apply very well to real life here. In real life, you learn as you go before you choose the next person. So generally, it's not like, here's 100, go for it.
Yep.
Right? It's like, think about dating.
You don't even know what the N is. You don't know what N is.
Exactly.
Yeah.
So if I'm dating somebody, right, I go on a date and I learn things about my own preferences.
Yep. And yourself and
myself. And then that informs my choice of the next person I go on a date with. So that's the first thing that's different. The second thing that's different is that in real life, I can often go back to options that I've rejected in the past.
Yes. Okay.
Which I cannot do here. So I do think that we need to take that into account. But understanding this idea that you should do some sampling before you choose, I think that that's a really valuable idea to understand. But I don't want you to say, how many people do I think I'm going to meet? And then that's how, then I'm going to reject everybody, right. Like, cause I mean, it's a very interesting problem. But it's not, it's not a good isomorph. So if we go back to the apartment hunting problem, you could, I suppose, say, I'm going to look at 10 apartments and then I'm going to choose after 4. You could do that. But you have to remember that you don't need to just pick 10 apartments. You can go look at a few apartments and say, I thought that I was going to like this, but actually it turns out I don't like this neighborhood very much, or I actually do want a third bedroom, or I don't, whatever. And then that's going to inform your choices about the next department. Then you look at number one. And even if you didn't do that, it's not like you can't say, you know what, I want to go back to the first apartment.
Yeah. I mean, sometimes you can't because they go.
Sure.
Yeah.
Sure. Sometimes you can't because they go, but sometimes you can. And you should always sort of be taking that into account. So that's like with hiring, I really do approach it that way because, you're getting candidates and then you're like, maybe I should change my job description. If this is the pool that I'm getting, like, as you start to talk to people, like you realize you should have specified different things, or it's attracting someone who has a whole set of people who aren't a good fit. And so there you're learning as you go. And so you may actually you could change your job description, for example, really, you should change your screening process.
Now, in poker, you talk a lot about like things like mathematical decision making, but you also in your poker career, I think, talked a lot about the importance of being able to read people. I'm personally terrible at reading people. What are like one or two things that somebody like me can do to get better?
Yeah. Okay. So a couple of things. In poker, the bulk of the work that you're doing, assuming that you're not playing just game theory optimal, let's assume that's not what's happening.
Yeah.
But you're actually playing an exploitative game. And I just want to be very clear. I'm using exploit in the game theory sense, not in the manipulating.
We're amongst data nerds.
I know.
We know what you're talking about.
I just always feel like I need to say that. But somebody has tendencies which you can exploit, and so you're actually you're not playing game theory optimal in that. You're not following Nash equilibria or anything like that. You're like, I know that Auren calls too much.
Yep. So
I'm not going to bluff him very much, but I'm going to be what's called the nuts peddler. I'm going to start running the nuts into him because I know he's going to call me every time. So you'll change your play based on what the other person is doing. When you're playing cash game poker, a lot of what you're doing is actually really just trying to create a model that's better than the general base rates for the player that you're playing against, right? So if you're like, given that I know nothing about you, right, I'm going to assume you're going to enter 20% of the pots that you play in a 9-handed game, and this is going to be your range for opening hands and things like that. So there's a whole bunch of things where I'm going in with like a general model given reference class of poker player, right? And I could have some general, like, easy ways to actually get a little bit more refined even before I know you. So if you're a retiree at 10 a.m. on a Wednesday morning, that's a different reference class that I'm going to be pulling from before I've ever seen you play a hand than if it's 2 a.m. on a Saturday and you're drunk.
Yep.
Right. So that's a whole other. So I have different reference classes, but that's going to be my starting point. That's going to be my prior. And then what I'm trying to do as I watch you play is update my priors to refine my model of you personally.
But just with data, not about reading them in
just
a way?
With data.
Okay, because then I could do that, like with the data. My problem is reading the person.
Then there's a reading people part. Okay, so you're doing that just with data, but that's actually really important to do, right? Because one of the mistakes that a lot of people make is they think that other people play just like them. We don't want to do that because people are different. And I want to be able to see if there are some holes in your game. And if I can find those holes, then I can exploit them. And I can win more money that way. So that's a nice thing to do, is build a model of your opponent. Okay. But where does the reading come into play? So when I'm playing poker, always what I'm trying to do is to narrow down the range of hands that you are holding. So I can't see your cards. I don't get to see your cards. But what's going to be different between a really great poker player and like an amateur is that the possibilities of hands that I think you have is going to be narrower and more accurate than what an amateur might think you have. So it's not that I'm going to think that you have every 2-hand combination, because I'm going to be like, well, he plays a low percentage of his hands and he's opened in first position and he doesn't bluff a lot. And so now I've got you narrowed down pretty tight, right? Like, so I'm going to be better at doing that. Now I'm going to do a lot of that just from the data work. Have I built a really good model of you? But some of that is going to be from reading my opponents. And when that's going to be the most important, and you're going to hear this as an echo from what we talked about before, is when it's a really close call. So remember when I said, like, what's the threshold for getting to good enough, right? If the price I'm getting from the pot is really big, I should not spend a lot of time trying to read you, because I don't actually want to convince myself to fold, because I'm totally fine. I'm totally fine with investing there, knowing that I may end up with a false positive. Why? Because maybe I'm getting 10 to 1 from the pot.
Yep.
Right? So like my break even, I'm making money if I win 10% of the time, if I'm getting 10 to 1, like I'm making money. So I don't want to have false precision there, right? I don't want to be thinking that I know more than I do. And so I'm not going to bother reading you or anything. I'm just going to go, I'm getting 10 to 1 from the pot. Like, could I win 10% of the time? Sure. Okay. And I'm going to call. Okay. So that, but when it gets close, right? So when you're in a situation where, say, you're getting 2 to 1 from the pot and you're like, well, I have to win this 33% of the time, and this is pretty close.
Yeah.
Now reading your opponent can actually get you to fall onto one side of the fence or the other. And that's where it becomes really incredibly important. So how do you read your opponent? Well, number one is to recognize that when people are being stared at, they don't like it. And so you can get a lot of what are called false tells when you're just like staring somebody down at the table because they're just uncomfortable. Would you want to be stared at really hard?
Definitely not. Yeah.
No.
I'm the kind of guy that looks at my shoes. So yeah.
Exactly. So you might start doing some stuff that like I connect to your hand that's really actually just about general discomfort that's being created by like it's a long time that I've been sitting there and staring at you. So generally what you want to understand is that whatever physically you're getting from somebody, you're going to want to get relatively early on. Right. And that's generally going to be better. It's not that someone might not give you something later on. It's just, I think it's just a lot noisier when that happens.
Yep.
Okay. So what am I going to be able to see? There's a whole bunch of signs of discomfort and there's signs of happiness, right? So as an example, interestingly enough, at the poker table, when someone's like moving their knee up and down, you know, like it's actually a sign of nerves. It's a sign of a good hand. It's like a dog wagging its tail.
Okay, interesting.
So
when they're kind of jittery, you know, they're
well, it depends. If it's specifically when the knee's going up and down.
Knee. Okay, interesting.
Right. When that, you know, that happens under the table, then it's
that was like a Sam Bankman-Fried thing with his knee going up and down all the time.
Right. So in a lot of settings, like a social setting, it might be a sign of nerves or being nervous or anxious or something like that. In that particular setting,
right. If you see it and it's not normally the case, then okay, then maybe they've got a good hand. Okay.
Because think about it, like if someone's really
but now everyone knows that, so now everyone just like bounces their knee up and down.
That's true. Now they'll bounce their knee up and down. There's a whole bunch of stuff that has to do with the mouth. There's these self-soothing behaviors. So if you see someone ever like sort of like rubbing their hand on their fingers, or if they're moving their tongue on the inside of their cheek, that usually means that they're bluffing.
Oh, okay.
Or they're uncomfortable with their hand, because it's called a self-soothing behavior. So anytime so with a man, if they have a beard, don't do this. But if they're like sort of rubbing the back of their neck, or sometimes they'll be sitting at the table and they'll be sort of going like rubbing their fingers, or if they're going like on the inside of their cheek or something like that.
But again, now everyone knows that. So you think they like assume if you know that, other people know that. So now they're like faking it.
That's true. Except that
it's hard to fake.
Yeah, because involuntary actions look really different than voluntary ones.
Okay.
You can also look at like something called hooding. So have you ever seen someone where like, and you kind of always instinctively know they're lying when they say the thing and they sort of have this really long blink and then they open their eyes? That's called hooding. But there's actually a great guy who talks a lot about these body language. His name is Joe Navarro.
Right. Of course, I read his book. Yeah.
Yeah. So he's got great work on this idea of like how do you actually read people.
Interesting, and like. I've basically gone through life I just like assume everything people tell me is 100% true, and it's generally worked out pretty well. Like is there any other advice you'd have for someone like me who just like assumes everything you tell me is correct?
So I think that's interesting. So I think most people are telling you the truth. I agree. I think that what we need to understand, though, is that whatever their interpretation is not necessarily true.
Yep.
So
It's their belief of it.
It's their belief of it. But I think, people talk a lot about misinformation online. There's work by Duncan Watts, which shows that like misinformation versus what we call like misleading. Information is 46-1, like misleading information 46 times the problem.
That makes sense.
And the misleading isn't people purposely trying to mislead you. It's they're telling you some data
from their side of the story.
Yeah. So like an example, you see a lot of people talking about crime statistics online a lot. And when people tell you that New York is more dangerous than Macon, Georgia, they think they're telling you the truth. Because they're like, I don't know how many murders were in New York last year, but maybe 350 or something like that. Well, let's look it up. I have the interwebs. Let's see.
I like this. We're doing live. We're live reporting here.
Okay, so last year, let's see.
Just because safety is always this hard thing because it's not just the number of murders, it's all the other crime, and it's just how you feel, and it's like you feel safe walking around, and do people stare at you? Does someone just yell at you? And that makes you feel unsafe, even though there may not be a crime to yell at somebody. Right. So these things are very, very like psychological, I imagine.
Okay, so it doesn't tell you for all of 2020. This figure that I have doesn't tell me for all of 2024, which is sad.
The interwebs are a problem right there. Like they're just
right.
But like these safety, but I think part of what you're saying is that these things are emotional. Like they're not just data driven, right?
Actually, so let's make up some numbers. This is what I'm actually saying. So generally, when they tell you that New York is less safe than Macon, Georgia, it's that New York had 350 murders and Macon, Georgia had 90. And they're like, see? New York is more dangerous.
Yeah. And New York is like,
those people are not lying to you.
Gazillion times the population
There's denominator neglect going on there.
Yep.
So what I think that there's all sorts of places where like the denominator hides in the shadows, right? Yep. Like people don't realize that there's a now if I said back to them, oh yeah, well, Georgia is more dangerous than New York City, they would understand there was a denominator problem right away.
Yep.
Right. Because they'd be like, wait, Georgia's a state and New York City is a city. But so actually, just so people know, because I have looked it up before, because Macon, Georgia is actually more dangerous per capita than New York City.
Okay, I've never been to Macon, but now I know. Okay.
And neither of them you're not likely to get murdered in either of them. But, but so people get that reverse. Now, look, I really don't think that the people who tell you that are lying. I really don't.
But by the way, even when people use real data, like they'll say, it's more dangerous to be in the city of Baltimore than it is to be a U.S. soldier in Afghanistan or something. And like, well, maybe that's technically true, but like I could probably avoid the danger more in Baltimore than I could if I was a soldier in Afghanistan or something.
Right. And they're generally making the mistake of telling you counts of things, as opposed to, well, how many total people were exposed, how many people ended up dying, that kind of stuff. So one of my favorite examples of this actually comes from the Washington Post. So I read an article in 2022, in the fall of 2022, and the title was, COVID is no longer a pandemic of the unvaccinated. So that was the title of the article. And so I thought, oh, this is interesting. I'm going to go read this because that time, I mean, the Washington Post definitely had a pro-vaccine bias. So I was like, oh, there must be some very interesting data behind this very interesting headline. And so I went and I looked at it, and it was that in the month of August of 2022, 58% of the people who died of COVID were vaccinated.
But I assume a very high percentage of the population was vaccinated by that point.
Yeah, well, you wouldn't know from the article because
Right,
that was
right.
the question
Yeah.
I asked,
Yeah.
and it wasn't in the article. Now, I think we can agree that that reporter was not trying to lie.
Yeah.
And if you go fact check that number, by the way, in August of 2022, where 58% of the people who died of COVID vaccinated, that will come up. Fact check. Yes.
Yeah. Yeah.
Right. Okay. So I asked the same question you did. I was like, wait a minute, what percentage of the population is vaccinated? And I went and looked it up because I couldn't get, it wasn't in the article. And at that time, 80% of the population was vaccinated. So I was like, oh, well, that seems like vaccines are pretty effective. I don't know. So then I was like, oh, well, also, I guess you need to do some age matching because there's a lot more vaccinated people who are old than young, and old people are much more likely to die.
Yeah.
Than young people. So it'd probably be good to do some age matching. I'm lazy. I wasn't actually going to do that, but I found a blog from someone who had done it. I was very lucky. And it turned out in the month of August, it was 5 times better to be vaccinated than unvaccinated. Now, the thing is, like, I have no truck with anybody who doesn't get vaccinated for COVID. Like, that's your own choice. The problem is that you're trying to make a choice that's data driven, and not everybody is Auren, who's going to go, wait a minute, how many people are vaccinated?
Yeah.
Maybe I should do some age matching, whatever. So you're just looking at that here's a newspaper. They're not trying to lie to you. They're drawing a conclusion from this data that is totally misleading. And now you're going to make a decision based on that data, whether to get vaccinated or not. My whole thing is like, I just want you to make a decision where you actually understand how you're supposed to make sense of the data. And then you can decide for yourself, you know, I'm 20, I don't have a lot of risk.
Yep.
Or whatever. Like, I don't care. You be you. Make your own decision about it. It has nothing to do with me. Right. So, but I think that this is generally the problem, right? Is I think that mostly people are telling you the truth, at least what they believe the truth is. But you aren't taking enough responsibility in terms of your own decision making to say, well, wait, how do I interpret the information that I've just been told? And I think we just sort of stop at someone telling us a fact wrapped in their interpretation. And then we don't actually say, well, wait, what more are we supposed to ask here?
Really interesting. This has been awesome. And last question we ask all of our guests: what conventional wisdom or advice do you think is generally bad advice? And we probably already went through a few today.
Trust your gut.
Trust your gut. Okay.
Yeah. Just like, that's got to be the worst. So what I would say is, if the decision doesn't matter, it doesn't have any long-term consequences, it's a super inexpensive door to go back through, sure, trust your gut. But like, you're going to end up turning into, you know, away from a lot of skids that you should be turning into. It's like, sometimes your gut's pretty good, but like, if you don't make explicit what your gut is, sort of how your gut is modeling a problem, you're going to just miss a lot of errors.
It's interesting. So I never trust my gut to do something, but I almost always trust my gut to not do something. So if it said to hire somebody, I wouldn't trust my gut. But if it said don't hire this person, I would definitely trust my gut. Where do I have it wrong there?
So what I would say is this, that if you've gone through a really good decision process and then your gut or intuition is like, I think that's a really good reason to go back and examine.
Okay.
Right. So I do think that when someone has a lot of experience, sometimes there's something that they may have missed and their gut is sort of putting up an alarm bell, right? I'm a little nervous about this.
Yep.
And I think that then you should go back and look, because I think the thing is that you should always strive to be able to do is actually give the real rationale for why your gut feels that way. Right. So I just think that's really important. Now, if you want to have a rule that your gut can't make you do something, but it can stop you from doing something, that might be okay. Except what if you're like super risk averse?
Yeah. Yep. Good point.
Right.
Which
Now
I am.
you're going to make a lot of really bad decisions on that rule.
Yep.
So that's why I don't like, what I like to do is think before I face a decision, sort of what are the things that I care about? What are my values? What's the threshold for deciding? I try to sort of think about all of those things in advance. Then I go through all the work of doing it. And then if there's something going ping, 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 I'm like, I'm going to go back and look at this work again.
Yeah.
What more information do I need to know in order to understand? Because I'm going to say, well, why is my gut feeling like that? Right. And then I'm going to go from there.
This has been great. Thank you, Annie Duke, for joining us on World of DAS. I follow you at Annie Duke on X. I definitely encourage our listeners to engage with you there. This has been a ton of fun.
Well, thank you for having me. This was a super fun conversation.
Thanks for listening. If you haven't already done so, please subscribe to World of DAS wherever you consume your podcasts, YouTube, Apple, Spotify, and more. And please help us get discovered by leaving a review. And check out worldofdas.com. That's worldofdas.com. And of course, connect with me on Twitter at Auren. That's AUREN. Would absolutely love to hear from you.